Good afternoon, this is Mike Peterson, the Bear Market Investor, with the market update for the 28th of August, 2011. We're here looking at the S&P 500 stock index in the daily time frame. We're also going to be looking at the intraday charts as well. Now let's have a look at the wave structure here in the daily time frame. As I've noted in prior videos, the top of the ABC correction from the March 2009 lows is right here. From an Elliott wave perspective, the price peak in the S&P 500 was actually right here, but many Elliottians and market analysts that loosely follow Elliott wave theory are placing the termination point of wave 5 of C at this point right here. The problem with that, as I've noted in the past, is that we had a 3-wave decline, a 3-wave rally, and a 5-wave decline, followed by another 5-wave rally. Now, I do admit that this wave here and this wave here are not exactly extremely clean or well defined. However, this does count well as a 5-wave decline as well as a 5-wave rally. That means that we actually had a running flat 4th wave correction. In a running flat, this type of scenario occurs where we actually exceed the top of the prior wave right here in the correction. That puts, again, the termination point of wave 4 of C at this level, followed by wave 5 of C. Wave 5 of C had to, unless in the case of a truncated wave, exceed the price peak here of wave 3 of C, and it did in fact do that. So it did not violate any rules. As far as truncations are concerned, truncations occur when you still have 5 waves, but that rule is not met. In which case, that is a very rare occurrence, by the way. You can have a truncated wave. From there, we had a wave 1 down, wave 2 up, wave 3 down, wave 4 up. Now, even though this is so far, and I believe will be, the price peak for wave 4, I don't believe that it's the termination point of wave 4. Last week's video left that a little bit in question. And that is, it was entirely possible that we began the 5th wave down here, but I wasn't really totally sure of it based on the intraday wave structure. It actually counts very well with this particular decline right here in the intraday charts as a 3-wave decline. From there, we had a 3-wave rally in wave C of the triangle, followed by a 3-wave decline in wave D of the triangle, and then we are working on, or have already completed, 3 waves up in wave E of the triangle. That would terminate the triangle and the 4th wave and allow us to continue moving down in the 5th wave. Now, again, there are a number of different possibilities, but based on the intraday wave structure, I believe that the best scenario here, the most likely scenario, is that in fact we are tracing out a 4th wave triangle. Oftentimes, when you have a 2nd wave like we had right here, retrace a very deep percentage of the 1st wave down, that suggests that you should have a much more shallow retracement as far as percentage is concerned of the 3rd wave in the 4th wave. That is the case here in a triangle. Now, it's also the case from right here in that we did, I believe, move above the 38.2% retracement of that 3rd wave down. And actually, as I had noted in the prior video too, this long-term trend line that I have, as well as these two right here, but this one in particular for this comment, goes all the way back to the 2000 peak in the S&P 500 stock index. We came back to backtest that to the point, to the hair, and that was what I was suggesting would happen. From there, again, we declined in what I believe was that 3-wave structure, and then we are continuing to trace out this triangle in the 4th wave. Now, as far as the MACD histogram is concerned, we never did get that bullish divergence. Not yet. I was suspecting that if we were indeed moving down in the 5th wave here, this would continue to tick down. Now, oscillators and indicators in general can start to really give some bad signals when you start moving into triangle type formations. That is because for a lot of momentum traders, they're probably beginning to get pretty bullish right here, when in fact that very well could be a bad signal. So Elliott wave structure is very, very important. As I've noted, some forms of analysis would have this as a bullish scenario right here, and that we should continue to the upside. Based on my Elliott wave analysis, this tells me that our oscillators and indicators, such as here with the MACD histogram, would in fact be giving us bad signals at this point in time. So I'm ignoring these, at least for right now. What I do believe is going to happen, if this is indeed just about the termination point of the triangle, is that we will see this begin to tick down again. And when we do, when we complete that fifth wave down, we will have a bullish divergence in place in the MACD histogram. And that will usher in a big, big, big rally in the S&P 500. How big remains to be seen. This fifth wave could actually be pretty long, but it also may not be as well. I suspect that it may be at least 100 points or so. But again, price is not specific here. We are looking to take out this low right here. Once we do that, then we want to begin to look at the wave structure and tell us what we should expect near term. From that point, once we look like we're more or less completed that fifth wave to the downside, I am going to pull my short positions out. I'm going to do so in anticipation of that second wave up, meaning 5 waves down here will make a larger first wave down in the S&P 500. From there, we can expect some sort of correction to occur in a second wave up. And I'm guessing that it may be a deep retracement similar to what we had here. And in that, you will probably see very positive news come out, or hope in the markets that things are going to get better, that the worst is over. It will get worse, at least for a little while here, because of the fact that we are expecting that fifth wave down to occur. So you should see a little more negative news come out in the coming week, I believe, based on the wave structure and the way that I'm analyzing it. From there, you'll see that bottom occur, and then you'll see a rally in optimism, a rally in the markets. You'll probably see the president come out with some sort of new stimulus package or proposal or something like that. You'll maybe hear a little bullish talk from Ben Bernanke, who knows. Just put that into context of a second wave. In this particular case, second waves generally tend to move back in the direction of the trend of optimism or pessimism that preceded it. So in this particular case, as optimism, or as the second wave rolls up, you should see optimism improve and become more bullish. And that's, again, part of the fundamentals behind Elliott wave and the type of investment psychology that you can expect in wave structure. After that third wave down begins, after the second wave, people will become much more bearish because they're going to realize that they were wrong. They were wrong to believe that the markets were in fact going to go higher. And so that will catch a lot of people by surprise. And then you'll have a lot of panic selling. The markets will sell off very deeply. Now, if we get a deep second wave retracement, we can also expect a similar type of circumstance to occur in a fourth wave to the downside once we get there. So we'll cross that bridge when we come to it, and that is a ways off yet. But I do want to forewarn you that we probably will see some sort of minimal retracement if we in the fourth wave if we see a deep second wave retracement. Let's go and have a look at our intraday charts. Okay, we're looking at the hourly chart of the S&P 500 stock index, and what I want to show you is, once again, how well we back tested that long-term trend line in blue, as that you can see there, going all the way back to the 2000 peak in the S&P 500. This is all original chart work of mine, as I was also showing you in the volatility index, which is, I think, something you won't see anywhere else. Now, in last week's video, we had more or less a three-wave decline. I just wasn't totally sure whether this small piece right here was really the beginning of a third wave to the downside and a larger fifth wave that we expect to take out the low here. However, it stopped right about there, moved on up, stalled out before reaching this price peak right here, came back down, made a higher low, and then again a lower high. So I'm not 100% sure that we have yet completed wave E, and that this would be wave A, wave B, wave C, wave D, and then wave E. So I don't know that we've yet completed that wave structure, but I do believe that we're pretty darn close. Once we finish that up, we should see a thrust down in a fifth wave. That fifth wave will be, of course, comprised of 5 waves. Once we complete that, we can expect that larger rally to occur that I was talking about. Let's have a little bit closer look in at this wave structure right here to see just how much higher we could go if we do. Okay, we're looking at the 50-minute time frame of the S&P 500 stock index. I'm going to show you a little closer view of this fourth wave triangle structure that I believe is currently underway or has just terminated. And that would put wave A up, terminating at this point right here, followed by wave B down, either terminating here or here, depending on your wave structure interpretation. From there, we terminated wave C up at this point, wave D down, and then wave E up. Wave D down was a very clean 3-wave decline. Wave E may or may not have yet terminated. Based on this small decline right here and the subsequent rally into the end of the day, I believe that we do have a little bit more upside to go before terminating wave E. From there, that will terminate, of course, the fourth wave, and we will proceed lower in a fifth wave. That fifth wave should take out the low of the third wave that we saw in the hourly and the daily charts. Once we see the termination point in at least a clean 5-wave decline within the fifth wave, we should see that larger second wave rally to the upside occur. That's where you're going to see a renewed sense of optimism in the markets, and news is going to begin to get better. That's where people are going to believe that the worst is in fact over, and the markets are just going to proceed on to recover to new highs. Now, I hope that, at least based on my analysis and what I've told you about the psychology behind Elliott wave theory, that you'll at least be able to see the other perspective as well, the bearish perspective. Okay, if you like the type of analysis and videos that I'm producing for you here on this Bear Market Investor YouTube channel, please do go ahead and rate or comment on this video. I would sincerely appreciate it. I really like to see that people are interested in the type of analysis that I'm doing on the markets and presenting it to you free of charge on this YouTube channel as often as possible, hopefully once a week, if not more often. If you are not currently a subscriber of this YouTube channel, please, I invite you to become one. Again, it's just a way of showing me that you're really interested in what I'm doing here, and it motivates me to continue doing it. Have a great weekend, guys, rest of the weekend, and I will see you sometime next week. I'll certainly try to comment on the market as things unfold. See ya.